Welcome to the Retirement Made Easy podcast. I'm your host, Greg Gonzalez. My goal for the podcast is to help you live a better life in retirement by giving you the tools and information you need in a language that you can understand. And this episode will be no different. On today's episode, we're going to be talking about taxes. Are higher taxes better for the stock market? Are they better for you and I? We're going to talk about this and break it down. So many people out there are saying, well, companies like Amazon and all these big Fortune 500 companies are paying next to nothing in corporate taxes. Why is that? Why do they get the tax breaks and I don't? Some people believe that the wealthy, those who make $400,000 and more, need to be paying more taxes and be paying their fair share of taxes. So we're going to talk about that on today's episode of the Retirement Made Easy podcast. You're not going to want to miss this. Before we get into today's topic, I want to mention our website, which is retirementmadeeasypodcast.com. That's retirementmadeeasypodcast.com. There you can check out our free resources, such as our retirement secret sauce, as well as our 2020 tax planning guide that people tend to really like. So check those out. And while you're on the website, you can listen to past episodes of the show. You can also send me questions at the bottom of the website. It says, Ask Greg a question. You can submit your question. I always love hearing from listeners. So check out our website, retirementmadeeasypodcast.com. I know it's a mouthful, but you'll find us there. So on today's episode, I wanted to talk about taxes. We're in a very low tax environment right now. I know there's a lot of people that are upset that a lot of corporations are not paying, quote, their fair share in taxes, like Amazon, for example. A lot of people always bring up Amazon. But let's talk about corporate taxes. Let's talk about individual taxes. I'll start with corporate taxes. So there's a lot of people out there that believe that corporate taxes should be higher. They should be much higher. So what I wanted to bring up is the fact that companies like Amazon pay very little in taxes. They might have credits or subsidies that are helping them from a tax perspective. But what they bring to the country, the economy, is they're incentivized to hire a lot of people and really grow their business. That's what they're set up for. So if you give companies like this an incentive from a tax standpoint, they're able to hire more people and really improve the overall health of communities. That's the deal. But I heard someone recently say we need to really drastically increase the taxes that companies like Amazon pay. And so let's talk about that. Let's say we increase the taxes that Walmart or Amazon or Target that they pay. Right? The corporate tax rates. Let's double them. So if you're in charge, if you're one of the people in management at Walmart or Target or Amazon, and you find out that next year taxes are going to double, you've got to take some action, right? So the first thing you would do if you were Walmart or Target is if you know taxes are going to double and you're in business to make money, to profit, Walmart and Target, they want to make money to improve shareholder value, right? So their stock price goes up, the corporation makes more money, they can pay out dividends to shareholders. They're set up for success. So if you were in charge of Walmart or Target and you heard that the corporate tax rates were going to double next year, what would be the first thing that you would do? If I was in charge, you would have to raise the prices on the goods that you sell, the goods or services that you sell, right? So if you're Walmart, your prices are going to have to go up across the board. You're going to have to look at all the items that you sell, the services you offer, and you're going to have to increase the prices that you charge all consumers. So if you think about that, if Walmart doubles its prices because it knows that taxes are going to double, who's actually paying for this increase in corporate taxes? Is it Walmart or is it you and I as the consumers, as the people that shop at Walmart or Target or Amazon? Well, all they did was increase their prices. It's you and I as the consumers that are being punished. We're now paying more for the same goods because the federal government raised the taxes on Walmart, right? So really, the increase in prices was just a result of the increase in the corporate tax rates, and it just got passed off to the consumer. And that's really the unintended consequence of raising corporate taxes on all these big companies that we all patronize. Again, Walmart's in business, Target's in business, and Amazon is in business to make a profit for its shareholders, right? So they're not going to leave their prices the same when they know that their corporate taxes are going up. They want to net the same after taxes, so they have to increase prices. Let's just assume that as a result of an increase in corporate taxes, Walmart increases its prices by 10%, right? Let's also assume that we shop at Walmart. That's where we do our grocery shopping. We buy our toilet paper and all of our household items from Walmart. And across the board, on average, our grocery bill, our shopping bill goes up 10%. Let's also assume that at work, we got a 1% raise in our paycheck. Well, that really didn't do much good for us, did it? Because our grocery bills went up by 10%. Our income that we're bringing in only went up by 1%, so we're 9% behind. And I realize that your entire paycheck is not spent at Walmart. But I'm just trying to make a point here that if you decide to increase corporate taxes on these big companies that we all shop at, we all buy from, all they're going to do is pass it off to you and I, the consumer. And not only that, they're probably going to be less inclined to keep hiring new people. So that's not good for jobs. If corporate tax rates go up, they may not want to hire as many people as they had previously planned on. So that's not good for the local economy either. But people don't think about the ramifications of these increase in taxes. It could be an increase in the gas tax. So let's say that your state says they're going to increase the gas tax by 20 cents a gallon. And Illinois did this just a couple of years ago. They increased, I think it was last summer actually, that they increased the gas tax. So if you have all of these companies that are shipping their goods to stores like Walmart and Target, for example, and they're shipping them in semi-trucks, and now they know that the price of gas to get the goods to the store is going to cost them more to transport it, well, guess what? Walmart's just going to pass that off to who? You and I, the consumer. So they're going to charge more for the products that are on the shelves because it costs Walmart more money to get it on the shelves because the tax went up. The gas tax went up 20 cents. But I think many people hear these politicians or these elected officials talk about the corporate income taxes and how low they are. They figure that some way, somehow, if we increase the taxes on the corporations, that will in some way decrease the taxes or the cost of living that individuals pay, like you and I. But it's just not the case. It's just not the case. If corporate tax rates go up and individual tax rates stay the same, it's going to all come back to us. And the consumers, the individuals, are going to end up eating some of the increase in the corporate tax rates. It's just inevitable. Unfortunately, it's not a seesaw where they're paying a lot, we're paying a little, or vice versa. It's us or them. That's not the way it works. Again, the corporations are going to pass their increase in corporate taxes off to the consumer. That's just the way it works. That's economics. That's business 101. Also, let's talk about increasing the taxes on the wealthiest people. Those considered wealthiest being those that make $400,000 or more annual income. So if you tax these people, many of them are business owners, right? So if you tax these people more, what does that mean? Well, number one, let's assume this person owns an electrical company and makes $400,000 or $500,000. So if you increase his individual income and he owns a small, like an LLC, small company, right? Family-owned business. If you increase his taxes, he's probably going to just increase the price of his electrical services that he charges his customers. And also, he may be less inclined to hire new people for his business. So that's not good for jobs in the local economy. So again, our electrical owner here makes $400,000 or $500,000. He doesn't want to take home less money. No one wants to take home less money. Think about that. No one wants to see a tax rate increase because essentially what that means is you're making less money because you're paying more money in taxes. So to offset that, it's natural to have a response of, okay, in order for me to get back to where I was, I'm either going to have to do more business and do more work and more projects, sell more things, sell more services, or I'm going to need to increase my prices. So some people just start at increasing the price of their product or service, or most people would do that are in business. So let's say I need some electrical work done at my home, and I call this business to have them come out and do the work. They're going to charge me more than they used to because the individual taxes went up on the small business owner. So he just passes that off to me, the customer. So what I take from this discussion is it all goes back to, and it's all paid for by the middle class family. They're the ones that are consuming these goods and services, and they're having to face the unintended consequences of increasing the taxes on corporations and high-income individuals. And what happens is the price of goods and services goes up, and the middle-class family pays more, and they have less money to work with in their budget because they're paying more for everything now. Again, if you increase the gas tax by 20% per gallon, well, the middle-class family, they go to work, they pay for gas, they travel, they do all these things on the weekends, paying for gas. So they're in their budget, what they pay for gasoline is going to go up and up and up, but the gas station owner, they just pass that off to the consumer. And guess what? For publicly traded corporations that trade in the stock market, so when you think of the stock market, and I mentioned Walmart and Target, they're publicly traded companies, and you can buy their stocks and invest in those companies. And the success of the stock market, all, in my opinion, comes back to earnings of these companies. So the more money these companies make and the better their earnings look like, the better the stock is going to do. So the stock price may go up and up and up as earnings keep going up and up and up. So if a company is beating earnings expectations and is just growing by leaps and bounds and is just growing like crazy, well, the stock price is going to probably go up and up and up and keep increasing and increasing as the company continues to make more and more money. So the more money these companies make, like Walmart and Target and Amazon, and the better they do, the better the stock price, generally speaking, will do. It'll follow its earnings. So if we raise taxes on all these different corporations, they're going to react by increasing their prices. Why? Because they want their earnings to keep going up and up, so their stock price keeps going up and up. They are incentivized to make sure the company keeps growing and making more and more money. So I hope this discussion has been helpful for you. So many people think that if we increase taxes on corporations and increase taxes on high-income earners, what that means is there's less money that needs to be paid in by the people that make under $400,000 of annual household income. But what I want to stress is the fact that it's not them versus us. In other words, if you increase the taxes on the corporations and the high-income people, then the lower-income people don't have to pay as much. It's not a fixed number of taxes that gets paid in. And if you increase it on the higher-income families and the corporations, then there's less that would need to be paid in by the middle-class and lower-income families. And therefore, the middle class, lower income families and people would have no consequences. They would be exactly the same. And that's just not the way the economy works, unfortunately. That's not the way the world works. Most of us, if not all of us, spend money at these corporations and at these small businesses. And what happens when those businesses face an increase in their taxes? They get passed off to the consumer, to the customer. I hope this discussion today has been helpful in explaining the ins and outs of income taxes and corporate income taxes, and hopefully you've learned a little bit along the way. I want to remind listeners, check out my website, which is retirementmadeeasypodcast.com. If you have any questions I can help with, you can catch me right there on the website at the bottom, Ask Greg a Question. I'm Greg Gonzalez. I'll catch you on the next episode of the Retirement Made Easy podcast. And remember, always dream big. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, please consult your attorney, tax advisor, or financial advisor prior to investing. This is a hypothetical example and is not representative of any specific investment. Your results may vary. All performance referenced is historical and is no guarantee of future results. All indices mentioned are unmanaged and may not be invested into directly. The SmartVestor program is a directory of investment professionals. Neither Dave Ramsey nor SmartVestor are affiliates of St. Louis Retirement Advisors or LPL Financial. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA, SIPC.